Hey, welcome back for another CISI session, which is covering off the content of Level 2 Fundamentals of Financial Services. This is session number 7, where we are going to be focusing on the cost of borrowing. So this is continuing chapter 3 of banking. Okay, so this is the third element of this qualification. Now, in previous sessions, we have looked at retail products and services. So financial products and services that are offered to members of the public, so personal borrowing, personal saving. That's what we mean by retail products and services. So we've looked at things like mortgages, credit cards, personal loans, pawnbroker lending, payday loans, overdrafts. Okay, so these are all products and services offered by retail banks or building societies, and these are products and services offered to the general public, and in some cases, small businesses. Okay, and if you remember, that's what we call corporate banking. And corporate and retail banking, again, to recap, fit under that US umbrella term of commercial banking. Okay, so what we're going to look at today is we are really going to look at interest, and we are going to look at how you calculate a particular type of interest. So what we're going to look at, focus on over this session, is knowing the difference between what's called the quoted rate of interest when you borrow money and the effective annual rate of interest when you borrow money, which is also abbreviated to EAR, so effective annual rate. And you are going to need to be able to calculate the effective annual rates of interest based on the rate quoted by the bank and the number of times interest is paid on the borrowing, the amount borrowed. Okay, so this session is very much about interest paid when you are borrowing money, and we're talking about retail financial products. So we're talking about products that individuals, members of the public like us, or some small, medium-sized businesses will use to fund certain things. So the first thing to really look at is what actually is interest. Now, we have spoken about interest on numerous occasions in some of the previous sessions, but it's important just to define what it actually is. Now, there's two ways that you can look at interest. The first is in terms of borrowing money. And interest really is the cost of borrowing that money. It's how much is charged by the lender to an individual that wants to borrow money. So you take out a loan or a credit card and you borrow a certain amount, okay? And on top of that amount, they charge you an additional, normally percentage rate on top of the amount borrowed, which is the fee, if you like, the charge for borrowing that money. Okay, obviously they don't do it for free. They will charge you. They don't lend you money for free. They will charge you to borrow that money. So interest can be seen as the cost of borrowing. On the flip side, if you cast your mind back to when we looked at fractional reserve banking and how banks traditionally make a surplus, what banks also do is they pay interest to those savers depositing money with them. So if you deposit money in a savings account or in a normal current account, you will be paid interest on any money that you have in that account over a period of time. So interest isn't always a charge or a cost. Sometimes it's a receipt, it's money that you get as a reward or thank you for saving your cash with that bank. Okay, and if you remember when we spoke about fractional reserve banking, what traditionally happens is the cost of borrowing, so the interest charged by a bank to a borrower, will be higher than the interest that is paid by the bank to savers who have deposited money with them. And if you remember, that then generates a surplus because the bank has more interest coming in than they're paying out. And then you take away the expenses for the bank from that surplus, and that gives profit from which shareholders are paid, and banks or building societies can determine what they want to do with that money. Okay, so interest is seen very much in two ways, either the cost of borrowing if you're borrowing money, or the reward for saving, where interest is paid to you for saving money with a bank. But what we're going to focus on in this session is the cost of borrowing. So interest in terms of an amount charged for borrowing money. Okay, so when you repay a loan, there are basically two elements to your loan repayments. So the first is that you are paying or repaying the capital amount of that loan. And what we mean by that is basically the amount of money you have borrowed in total. So if you take out a loan for £10,000, the capital amount is £10,000. Okay, so that's the amount of money that you borrow from the lender. But on top of this, as we've said, interest is charged as a cost for borrowing that money. It is a charge whereby, you know, the financial firm or the bank, it's a charge from them to lend that money to you. They do not do it for free. So the interest has to be added to the capital amount borrowed by the individual that is taking out the loan. Okay, now interest is calculated normally as a percentage based on the capital amount or the amount outstanding that is borrowed. Okay, so normally interest is displayed or highlighted as a percentage rate, and it's normally shown what they will charge as an annual percentage on top of the loan. So it's normally quoted as a percentage per annum per year. So that's really just summarizing what we mean by interest, but what we're concerned about in this session is more about the cost of borrowing that money, the interest paid on top of the loan, rather than the reward for saving. Okay. So there are two rates of interest that we have to be concerned about here for individuals that are borrowing money. The first is what's known as the quoted rate of interest. Okay. The second is the effective annual rate of interest. Now, these are different, and we will look at why this is, and then what we will do is try and calculate one using the other. Okay, so as I said, there's the quoted rate and there's the effective annual rate of interest, also known as the EAR. Now, the quoted rate is also known as the advertised rate of interest. Now, when you hear the term quote, I often think of a quotation given by someone offering a service. So it might be that I want to get an extension built on the house, and I go to a range of different builders, and I get a quotation from each one to understand how much it will cost me to build my extension and do whatever I need to do. And then I compare the different quotations I've given, and then I will likely go with the cheapest one. And when we say quoted or advertised rate, we are pretty much talking about a similar concept. So this is the interest rate that banks or lenders have to advertise to customers. It's a legal requirement. And what it does, it's a percentage rate that customers can then very easily use to compare different rates of interest for similar financial products. So you can look at you want to take out a loan, you can compare different banks or financial services firms, and you can look at the quoted rate or the advertised rate of interest, and you can very easily see which one is the cheapest. Okay. Now, the only thing with this is the quoted or advertised rate basically shows the customer how much it costs to borrow that money if interest is charged on an annual basis. So in other words, it shows you how much it's going to cost you in interest or the percentage interest rate if interest is charged once per year on the money you borrow. Now, the catch with that is that most loans or most forms of borrowing that an individual or a small business will take out will not charge you interest once per year. They do not charge it on one occasion in a year. They normally charge it much more frequently than that. So if you think about most loans or credit cards, what they actually do is they charge the borrower interest every month. So instead of interest being charged once a year, they charge interest 12 times a year, every month. You may find that some forms of borrowing will charge interest quarterly. So rather than monthly, they might charge it every 3 months or 4 times a year. in some cases, you may find that interest is charged every 6 months. But generally speaking, interest will be charged normally monthly. 90% of loans or borrowing that you will come across will charge interest to the customer on a monthly basis, 12 times a year. So what the EAR does, or the effective annual rate, is it takes the quoted rate of interest and it adjusts it to reflect the amount of times interest is actually charged. Okay, so the fact that the quoted rate shows interest charged once a year, what the EAR does is it calculates the actual rate of interest paid by the borrower if interest is charged more frequently than once every year. So the EAR is always higher than the quoted rate of interest unless the EAR or the loan is actually charges interest once a year. If the loan only charges interest once a year, then the EAR is the same as the quoted or advertised rate of interest. But as I said, that's very rare. It would normally be that you get charged interest monthly. So almost 99.9% of the time, the effective annual rate of borrowing, the interest rate, the EAR percentage is higher than the quoted rate of interest given by the bank. And you can see down here, there's an advert. I think this is a Santander loan quoting 3.5%, which is the annual rate or the quoted or advertised rate of borrowing. So this is on an advertisement. But what you'll find is that that loan probably charges interest every month. Okay, so what you'll find there is actually the effective annual rate, the actual rate of interest will be much higher, or will be higher, depending on how often interest is charged, will be higher than that 3.5% quoted to the customer. Okay, so how do we calculate the true rate of interest paid by the customer, or the EAR, based on the quoted rate given by the bank if interest was only charged once a year? Okay, so what we have on this slide here is a table, and this is based on a loan that is charging 6% interest quarterly. Okay, so the quoted rate in this case is 6%. That's the amount of interest that the bank is saying is charged if interest was charged once per year. But what this example is actually saying is that interest isn't charged once per year, it's charged quarterly. So in other words, it is charged 4 times per year, once every 3 months. So there is a way we can work out the effective annual rate by making manual calculations, quite a long-winded method. And we've got an example here on screen. So this example shows what happens if someone borrowed at this quoted rate of interest, with interest being charged quarterly. And this is based on someone borrowing £1,000 and them never making a payment in a year, okay, which obviously is very unlikely. But this just shows it for how you would calculate it in a quite manual way, quite long-winded way. So 6% quoted rate of interest charged quarterly, charged every 3 months. So the first thing to take into account, if you look at the interest rate column there, is when interest is charged, they don't charge 6% every time interest is charged here on a quarterly basis. What they do is, because 6% is the annual charge for interest, you have to divide that by the number of times interest is charged in that year. So interest is charged 4 times in a year quarterly. Therefore, we take the 6% quoted rate, that's the annual rate of interest, and we divide that by 4. That's why in that interest rate column, you see 1.5% for March, June, September and December, rather than 6%. If you add that 1.5% up on 4 occasions, that gives you your annual quoted rate of 6%, which is what we've been referring to. So let's look at this table. So if you borrow £1,000 from this lender that's charging you 6% per year, but interest is charged on a quarterly basis. So in January, we have our £1,000 loan, we receive it. So at that point, we still owe £1,000. No interest has been added because interest is added quarterly rather than monthly in this case. In February, we've got the same thing. So we still owe £1,000. We've not made any payments on the loan. Now in March, we come to the end of our first quarter, the first 3 months. Okay. Therefore, they charge us 1.5% interest. So if you work out 1.5% based on the £1,000 of the loan that we've received, that gives us a monetary amount of interest of £15 added to the loan. So we've still not made any payments on this loan, which again, as I said, is very rare. You would make monthly payments normally on a loan, but this is just being used for demonstration purposes. So at the end of March, if we add our £15 to what we already owe, we now owe £1,015 on this loan at the end of March. So in April, we still owe £1,015. We don't add interest again in April because we're not at the end of another 3 months, not at the end of another quarter. The same for May, so we still owe £1,015 in May. But then when we come to June, and we come to the end of June, which is the end of the second quarter, so 6 months in, so we've had another 3 months of borrowing this money, we then get charged another 1.5% interest on top of what we already owe. So we owe £1,015, we get charged 1.5% on top. That gives us a monetary amount of interest added to our loan of the capital amount of our loan of £15.23. So now we owe £1,030.23. So you add that £15.23 on top of the £1,015 that we already owe. So at the end of June, we now owe £1,030.23. Okay. Now, one thing to point out before we keep going is that you notice that the interest is now not £15 that we owe, it's now £15.23. Why is that? Well, the main reason, or the key reason behind it, is that instead of us owing interest on £1,000, we owe interest on £1,015. We are basically paying interest on interest. Okay, because the size of the overall amount that's owed, the capital amount plus the interest, and we've made no payments, that means that we are now paying 1.5% on a higher amount of money than we were previously. That is what is known as compound interest, when you pay interest on top of interest. Okay, now that can be quite a dangerous thing when you're borrowing money. If that's the case, if you are not paying back enough of your borrowing, suddenly the amount that you owe starts to go up as you end up with compound interest having an impact. So at the end of June, we don't pay £15, we pay £15.23 because we are calculating 1.5% on the 1,015, which is our capital amount of £1,000 plus the £15 interest that we accrued in March. So July, the balance owed still stands at £1,030.23. We haven't made any payments. Same again in August. But then we get to September and we are at the end of the third quarter. So we get charged another 1.5% interest. Instead of the interest being charged on £1,015, it's now charged on £1,030.23. That now means that we owe £15.45 in interest, which, as you can see, is higher than the amount that we paid at the end of the previous quarter. So if we add that to the £1,030 we owe, now gives us just under £1,046 that we owe to the bank. Again, October, we don't pay any interest. November, we don't pay any interest. But we come to the end of the fourth quarter, the final time interest is charged. So we now pay 1.5% interest on £1,045.68. In monetary terms, that's £15.69 at 1.5%. And again, it's gone up because we're not paying the 1.5% on the £1,030.23. We're paying it on the £1,045.68. So again, compound interest is having an impact, which again means that we now pay £15.69 rather than £15.54 as it was at the end of the previous quarter. That now means that we owe in total, because we've not made any payments on this loan, we owe the bank after a year £1,061.36. Okay. Now, there is a way that we can work out the effective annual rate just by taking that final figure. So if we break that down, the capital amount of the loan is £1,000, and on top of that is the interest. So we're actually paying a total interest amount at the end of the year of £61.36. Now, if you calculate the £61.36 as a percentage of the £1,000 you borrowed, so in other words, £61.36 divided by 1,000, that will give you 6.136. Okay, so that basically shows us that we have a balance or an interest owed as a percentage of 6.14%. Okay, so what we actually have is an effective annual rate of 6.14% if we were to round that up to 2 decimal places. So a loan that is charging you 6% interest once per year, or 6% interest per annum, if the interest is charged quarterly, the actual rate of interest or the effective annual rate you pay is 6.14%. Now, there is a much quicker way of doing it. Rather than writing that table out and trying to calculate it from there using fictitious loan amounts, you don't need to do any of that. There's a slightly long-winded, well, not long-winded, but slightly more complicated kind of calculation, but it's much quicker to do. So some of the steps are very similar to what we have just looked at in this table. So the first thing we do, which we did with the table calculation, is we take the quoted rate of interest, which in this case is 6%, and we divide it by the frequency with which interest is charged. So we've already got that in the table there. We take our 6% interest. Interest is charged quarterly, therefore 4 times a year. 6 divided by 4 is 1.5. That is a percentage. So every 3 months, we are charged 1.5% to borrow that money. Then what we do is we turn that percentage interest into a decimal. So you divide the interest rate by 100. So 1.5% divided by 100 gives us a decimal of 0.015. So that figure there, 0.015, represents the interest that we accrue every 3 months. So that's the interest as a decimal instead of a percentage that we have to pay every 3 months. The next thing we do is we add 1 to that decimal. Now, the 1 represents the capital amount of the loan. 1 in terms of a fraction or a percentage basically represents 100%, right? So what we've got here is our interest of 0.015 as a decimal, and then we add our capital amount, our total amount of our loan, which is represented by 1 or 100%. Okay, so it's 100% plus our 15% represented as a number. So 1.015. So we add 1 to the decimal representation of the interest rate. Then what we do is we take the 1.015 and we multiply that to the power of the number of times interest is charged. So in this case, interest is charged 4 times a year. So therefore what we do is we calculate 1.015 to the power of 4. So that's represented by 1.015 multiplied by 1.015 multiplied by 1.015 multiplied by 1.015. That gives us a figure of 1.0613634. Okay, so what that actually, if you look at that figure and then you look at the final figure in our table there, lo and behold, we pretty much got the same thing. So what we now do to turn that into the EAR percentage, we take off our 1, which gives us the 0.613634, and we multiply that by 100 to turn it back into a percentage, and that gives us our 6.14% effective annual rate. Okay, so again, our quoted rate of interest is 6%. Interest is charged quarterly. What that actually means is our effective annual rate is not 6%, it's 6.14%. So we are paying in reality 0.14% interest more, higher interest than we would be if interest was charged once per year. And the reason behind this is the impact of compound interest, the fact that we are paying interest on interest, because it's being charged more than once a year, we end up with a higher amount owed at the end, and therefore the percentage interest is actually higher than the quoted rate given. So before we work through some example, let's walk through one more, okay? So United Bank is offering a loan at a quoted rate of 2% per month. That's 24% per annum. What is the effective annual rate? So remember, what we do is we take the quoted rate of interest, divide it by the frequency with which interest is charged. The second step is to turn the interest rate into a decimal. So once you've got that interest rate that's charged in this case, every month, okay, you turn that into a decimal by dividing it by 100. Then we add 1 to the decimal, which represents the capital amount of the loan. And then we take that number and we multiply it to the power of the number of times interest is charged. So in this case, it's charged monthly. So therefore, we will have to multiply the rate by the quoted rate by the power, or the decimal we've got there, by the power of 12. We take off our 1 and then we times that decimal by 100 to get it back to a percentage. Right, so let's have a look. So the first stage, take the quoted rate and divide it by the frequency which interest is charged. Now, this question is being deliberately confusing because it's actually given us the quoted rate of 24% a year, because remember the quoted rate is when interest is charged once per annum, and it's already given us how much per month. It's telling us on a monthly basis interest is charged, and it's already given us the monthly rate of interest that the customer will pay, which is 2%. 24 divided by 12, which is the number of times interest is charged per year if it's charged monthly, that gives us 2% per month. So the second step is you turn that interest rate into a decimal, so you divide it by 100. So 2 divided by 100 is 0.02. Remember, that represents the interest that we are charged on the loan as a decimal. We add our 1, and remember the 1 represents the capital amount, the 100% of the loan, which is what we owe on that loan in total, the amount borrowed. And we've got our 0.02, which is the interest represented by a decimal added on top of that. So what it's basically saying is that 1.02 is basically saying 102% is pretty much what it's saying there. The value of the loan, which is 100% plus the 2% interest. We then take that and we multiply it to the power of the number of times interest is charged. 2% is charged monthly in this case. Therefore, we do 1.02 to the power of 12. That gives us a figure of 1.2682. Okay. Then what we do is we take off our 1, which gives us 0.2682, and then we multiply that decimal by 100 to get it back to a percentage to give us our effective annual rate, the true rate of borrowing, because interest is charged 12 times a year rather than once a year. And as you can see again, 26.82% is the effective annual rate. It is a full 2.82% above the quoted rate that is charged if the money is borrowed once a year. Now, that might not sound like a significant difference, but where this has a huge impact is if you are borrowing large sums of money. Okay, so the larger the sum of money, the bigger the impact of compound interest will be. And in this case, you can see 26.82%. If you're borrowing a significant amount of money, you will end up paying a lot more for the loan than the quoted rate might suggest. Okay, so the amount you have to repay will be significantly more than you might expect initially. So you have to be careful with the impact of compound interest, and that's why it's good to know what the actual rate of interest you pay or the effective annual rate of interest actually is, because it can be significantly higher than the quoted rate. And that's all down to compound interest and how that affects how much you're repaying. Okay, so I'm going to give you an opportunity to work some examples through yourself, and then we'll go through the answers. So you're going to need your calculators, okay? And we've got 3 examples for you to have a go at here. So question 1, a bank is quoting an interest rate of 5% charged half yearly on a credit card with a credit limit of £5,000. What is the EAR, effective annual rate, to 2 decimal places? So remember the methodology that we've been through and apply it to that question. So what I suggest you do is pause this video, unpause it when you've worked out the EAR, and then we will give you the answers. Okay, so hopefully you've had a go at answering that question. Let's have a look at what answer you should have got. So you should have got 5.06% EAR. So instead of the borrower paying 5%, in this example, they are paying 5.06%. So again, what we do is we take the quoted rate of interest, divide that by the number of times interest is charged. So in this case, 5% is charged, is the quoted rate, the annual rate. It's charged half yearly, so it's charged every 6 months, so that's twice a year. So if we do 5 divided by 2, that means 2.5% interest is charged to the borrower every 6 months based on what they're borrowing. We change that to a decimal to give us our interest represented by a decimal figure. That gives us 0.025. We add 1, which again, as a reminder, is the representation of the capital amount of the loan. And then we multiply that to the power of the number of times interest is charged. So in other words, it will be 1.025 to the power of 2. Okay, 1.025 times 1.025, because interest is being charged twice a year. That gives us a figure of 1.050625. We take off our 1, we then multiply that decimal by 100 to give us a percentage. The EAR is therefore 5.06%. Okay, so the second example, again, pause the video after we've spoken about this and see if you come to the right answer, and we'll give you the answer after that. So a mortgage lender is quoting an interest rate of 3.5% charged quarterly on a mortgage of up to £200,000. What is the EAR to 2 decimal places? So pause the video and we will give you the answer once you've come back to us. So you should have got 3.55% EAR. How we work that out? Again, 3.5% charged is the quoted rate charged annually, but this time it's charged quarterly, so 4 times a year. So we do our 3.5 divided by 4, which gives us 0.875% charged every quarter or every 3 months. You turn that into a decimal by dividing it by 100 to give us the decimal representation of the interest charged. We add our 1, which again represents the capital amount of the loan, and then we multiply that figure to the power of 4 in this case, because interest is charged every 3 months or 4 times a year. That gives us 1.03546206055. We take off our 1 again, okay, and we then multiply that figure by, or that decimal figure, by 100 to get it back to a percentage. In this case, 3.55% APR. So 0.05% more paid in interest in reality as a result of the fact that the impact of compound interest, and interest is charged quarterly rather than once a year. Okay, the final example. NatWest is quoting an interest rate of 6% charged monthly on a personal loan of up to £15,000. Okay, and what is the effective annual rate calculated to 2 decimal places? So again, pause the video, have a go at the calculation, and then let's see if the answer matches up. Okay, so in this case, you should have an effective annual rate of 6.17%. Again, if we look at the calculation, we take our quoted rate of 6%, but this time it's charged monthly. So once every month, 12 times a year. 6 divided by 12 gives us our 0.5% charge to the borrower every month to borrow that money. Divided by 100 to give us our decimal, our percentage interest as a decimal. Add our 1 for the capital amount of the loan. So we've got 1.005. We have to multiply that to the power of 12 this time because interest is charged monthly. That gives us 1.061677,81186. Take off our 1 and you multiply that decimal by 100 to give us our percentage. In this case, 6.17% EAR, which is 0.17% higher than the quoted or advertised rate from the bank. Okay, well, hopefully you got those right. You can very easily make these up yourself. Now, what you will find when you look at these questions, and some of these questions demonstrate the point I'm about to make, but the questions in the exam will often try and catch you out by giving you additional information that you do not need to know about. So when you are calculating this, there's only 2 things you need. The quoted rate is a percentage, the amount that's charged in interest once a year, and the number of times interest is charged. You don't need to know how much is being lent to you. You don't need to know anything else apart from the quoted rate, the amount that's charged once a year, and the number of times the interest is charged. Every other bit of information there is irrelevant. You don't need to know someone's what tax code they're on or whether they're a higher rate taxpayer. You don't need to know the amount that they're borrowing or any other information. You only need to know the quoted rate and the number of times interest is charged. So don't fall for, they try and test that you understand the calculation. So they will try and put what you might call a banana skin in there that you might slip on, and you use that information and therefore come up with the wrong answer. So in this case, you only need those 2 pieces of information. And as such, you can make these questions up. So you can just give yourself, right, 7% quoted rate charged monthly. Then you can work out what the EAR actually is. You can make them up very, very easily. You just need to set yourself a random quoted rate of interest and a random number of times interest is charged for that loan, which, as I said, is normally once a month. But in these calculations, you may get questions that ask you to calculate quarterly or calculate monthly or even half yearly in some cases. So they're just testing that you know the formula, you know how to calculate it. And remember, the exam is a multiple choice exam, so you will have 4 options. And also don't forget that the EAR has to be, unless the quoted rate is the same as the effective annual rate. So in other words, it's charged once a year, interest is charged once a year, therefore the EAR is the same as the quoted rate. Only that is the exception for the fact that the EAR percentage is always higher than the quoted rate of interest. Okay, so remember that. So if you get options in the exam which state that the EAR percentage is lower than the quoted rate, you instantly know that that is incorrect and you can eliminate those options as potential answers. I'm not saying that the exam is that kind, because it probably won't be, but that's one way you might spot incorrect options when you're looking at the 4 options given in the multiple choice exam. Okay, so my advice is make some of those up and calculate them. The more you practice this methodology, the more you practice that, the easier and quicker it becomes, and therefore you can very quickly answer these in the exam. It takes up less of your time. Okay, but I would say you're pretty certain, you're pretty much nailed on to get a question on this in the exam. You may even get more than one. Okay, so you do need to know how to calculate this. In the exam, there aren't any formulas given to you. You have to know it when you go in. The nice thing is that you will have 4 potential answers to choose from. So as long as you know how to calculate it, you can quite easily come to the correct answer. Okay, that is how we calculate the effective annual rate from the quoted rate given the number of times interest is charged. So that sums up everything that we need to cover off about retail banking. The next session will focus on investment banks and central banks, which then conclude the third chapter on banking in the qualification. There is a multiple choice test on the cost of borrowing in the Google Classroom, so there's more chance to practice some examples there. And there will be some pre-session work for next week when we look at investment banking and central banks. So please have a look in the classroom for that and make sure that you complete that ready for the session that we look at the next time. Thanks very much for joining us. Hopefully you found that useful and you now know how to calculate the effective annual rate from the quoted rate of interest. Thanks very much. Take care.